To taking stock, it's 12 o'clock, it's the 15th of December, 10 days away from the big man coming. And of course, we're feeling the effects of the Santa Rally by the big man, and not to by John, who's here, dressed like he's dressed like almost a Top Gun pilot. You know, like John. Just flying in your plane, did you land your plane? Right, let's take stock there. Cool stuff. All right. So, John, obviously you weren't here for yesterday, but big day yesterday, wasn't it, the markets?
Yeah.
Yeah, your stocks benefit?
No, I don't think so. No.
Okay. Well, what we're going to do for this taking stock, John has gone through 5 screeners, actually. The best performers of 2023, worst performers of 2023, that's on AIM and the FTSE All Share, and a growth of value screener, maybe stocks for 2024. As always, if you could, everyone, hit that like, subscribe. We're not at 5,000 yet, but we've grown about close to 2,000 subscribers since we started this. So It's going very well. And this is the last one of the year. I'm off next week. And so join in with the comments. Okay, what's your stock picks for 2024, everyone? 2024, what are you holding that you think could be, on that list for next year, the best performer? Let us know. And give us a reason as well, not just a ticker. Maybe a one-sentence reason of why it should do well. Let's have a look at, in fact, the indices, right? I was just looking at this earlier. But AIM All Share, John, it's trying to get up there. There we are. It's again yesterday a big rally and today a big rally. So that's a good sign. I mean, FTSE 100 down 0.5%. FTSE 250, it's up. It's that AIM is very similar. I mean, of course, the 250 is more mature, I suppose, domestic companies, whereas the AIM All Share toddlers, pretty much.
Yeah, but I mean, the 250 and the AIM All Share got. I mean, they've been the brunt of the derating.
Yeah,
more so than the FTSE 100. So I mean, you're kind of seeing that in the moves now.
Some miners there amongst the rises in the FTSE 100. Glencore is up. Anglo-American Smith DS is the top rise, up 4%. For Airtel, Antofagasta, Rio Tinto, Berkeley Group. What are the fallers today? Oh, St. James's Place down 5%, pretty much. Smith & Nephew, Order Trader, AstraZeneca, Rolls-Royce. Of course, that's been one of the big winners of the year, Rolls-Royce. But okay, marvelous stuff. So let's have a look at this then. Let's have a look at the. Let me scroll down. These are the best performers. The FTSE All Share, and of course, number one there. Wow, up 220%. That's like a tiddler, a small cap rally, isn't it?
It's amazing.
Phenomenal.
It's amazing. But this company had been struggling for quite some time. Yeah, and obviously, I mean, we've spoken about Rolls-Royce quite a few times, but the pandemic was obviously not good for business. But even before that, they had been struggling. So this is always a great company sort of waiting to happen again. Really needed some good management to come in and steer the company a new course, and that seems to be what's happening.
Look at that. Even when we put these lines on back here, it's gone up again. Heck of a rally.
Yeah.
When will this end? That's amazing there. And some of the other ones here, like a Carnival, of course, that had a bit of a nightmare. They have got.
But again, it's the same sort of story. You had a really horrendous exposure to the global shutdown. Carnival obviously being a very large cruise ship operator.
Yeah.
So as people head back out on holiday, it was set to benefit.
Yeah, look at that. It's now it hit that high. Look at that. I don't know if people held on to that. It hit that high of 1350 pretty much in July, and then came all the way back down to £8, and rallied back again, back at that level now again. Testing that previous. Isn't one hell of a ride. What else is there? Oh, Restaurant World, Marks and Spencer's.
Marks and Spencer, yeah. Well, they I mean, it's a really interesting one. Marks and Spencer again. I mean, there is a big theme throughout a lot of these companies that are the strong performers this year is that they are all to an extent recovery plays.
And unloved. They were unloved. Yeah, for a long time.
Yeah. So Marks and Spencer's was, I mean, obviously the UK's biggest retailer, but was really struggling in its sort of, non-food business. Food's always been, for a while, it's been really the growth engine of the company, but non-food has been struggling. And again, it's a turnaround story and a story of management coming in and getting this company, back on the straight and narrow.
Yeah. Well, do you know what? The next one, Vadim was on yesterday. He holds AO World. I don't know.
Again,
He's head of healthcare at SP Angel. So he said, "No, I do. Obviously, I love the markets, but he said he saw AO World, and he said, he'd been sold off massively, and he said they were improving their business model. It was getting better, and it wasn't a case of like massively improving. It was getting less worse, less worse, less worse, and now it's starting to improve. And he's held that for a while, and it has rallied recently. Oh, in fact, that's nice. I said, you see a series of higher highs there, but recently a couple of higher lows, but it has punched above that. So maybe that's going to consolidate there. But again, decent turnaround play. These are companies where, like I said, electrical, retailing, you think, well, consumer demand is going to be down. There's, the margins aren't going to be huge. But yet, if you start improving the business, and already that's priced in this, the worry about all that, and the business doesn't get any worse, starts then improving, you get this, the markets obviously ahead of the
yeah, yeah.
economy, aren't they?
Yeah,
So
indeed. But again, it's a sort of a self-help story. I'm just looking at the last half-year results, which were on the 21st of November, and what they're talking about here is really steps to improve profitability. So top line sluggish, but they've actually focused on the more profitable lines of business that they have. So removing unprofitable sales, they talk about at the top of the highlights. Adding delivery charges, controlling marketing expenditures. So all those things, making just a little bit more, operationally efficient.
yeah. Let's look at just the AIM all share best performance. Plexus Holding, which called Paul Scott
Yeah.
held. POS is the ticker. Don't be put off by the ticker.
It's an unfortunate ticker.
It's done very well. I did look at running through that. I think I hate to say this, but I think the big rise. You see, the thing is, there's no point chasing big rises that had massive rises, because down there it was, I think, excellent value and potential there. Up here, of course, the more share price rises, the less potential there is in it. So there's no point chasing, the best performers of the year. I think almost is worth looking at. We're looking right now the worst performers. But like I said, because Marks and Spencer's, all those Rolls Royce were the worst performers probably the year before. So, or the year before that. So it takes a long time for recovery to happen. So I wouldn't jump in on a worst performer, but it's worth monitoring them to see, are they going to get better? Are they undervalued? Are they going to, get back to revert to mean in some way? But
what you should be looking at, you have to be, on the lookout for a catalyst. What is going to make a business that's been struggling for a long time suddenly start performing better? Something has to change. And often that can be management, but we do see businesses cycle through new management teams trying to be that catalyst, and it doesn't work. But in this case, we've again, as you say, there's identify a clear catalyst that's going to drive a recovery. I mean, Plexus does leave me slightly puzzled. I mean, it's been around a long time. I'm not seeing vast improvements in terms of actually the trading performance.
No, it's all about potential. And to be honest, it was so you can see that sometimes when you get a company that's literally just bouncing on the bottom, it's selling's dried up. It's not going any lower regardless of what they hear. All you need is some interest in the stock. And that ticks it up. Then all of a sudden, people's like, Paul Scott's got a decent following, and you can start getting interest in it, and the share price rises, generates more interest, and it's self-fueling then, isn't it? And more people come into it, and it's liquid stock that can happen in micro caps and small caps.
It can.
But I did run it through my spreadsheet recently, and broke a forecast, and I didn't see a lot of upside from.
No, I don't see. I
did from there. From here it is, yeah, but not from here now.
But no, it is interesting. What the point you make there is that sometimes you do see sort of investors clustering around particular stocks, and you do see these very sort of sharp rises. We saw it, for example, with Ondo InsurTech. You get a bit of a buzz forms in the private investor market, and the share price goes mental. So
it did a 5 bag of there, but even now, it's a decent company. But if you look at
nothing's to say that these are inherently good or bad companies, but you just do see this trend where you see a lot of investors sort of hitching their wagons to a particular share, and off it goes.
It's more about momentum than the actual valuation of the business, and you realize sooner or later valuation will come through, and the tires will have to hit the road sometimes. And then the dreams that people have, it turned into reality a little bit sometimes. But
Yeah.
it's yeah. So in fact, on here, I did. Do you know what I gotta say? I bought Cornerstone about a month ago. You know, it did rise, but I wasn't quite sure. I saw lots of updates in the FX markets, these and a lot of companies, and some of the bigger players were saying this is becoming a very competitive market now. So more companies coming out, helping businesses with their hedging strategies and all that stuff,
Mm.
and so I just jumped out, and then all of a sudden. Paul Hill came out and talked about it, and I think him and Paul Scott covered it. And it went berserk. And I thought, oh, maybe I should have held that. But yeah, but there we are. You've got to have conviction, I suppose, in your plays. But
Interesting,
isn't that
interesting little market, the old FX. You've obviously
yeah,
got equal. I think Paul described Cornerstone as a mini equals, and
yes.
equals has done very well indeed.
And also, you got a previous guy, the COO of Equals, is now the CEO of Cornerstone. So
Yeah,
he's using
yeah.
that kind of playbook. So if you see the result of Equals, that's a very good play in the market. So if you can discover, looking at a winning company and then find one that's very similar on the routes and literally hasn't yet taken off. You can sort of almost say, okay, if he's going to achieve that, and that's a good playbook. Cornerstone, yeah. So U Group, yeah, it's been a fantastic performance. U Group, Hotel Chocolate taken out.
Take
Of course,
out
do you,
as is Restaurant
Hvivo,
Group in the larger list.
yeah, Hvivo is there, which is let's look at that. It's doing quite well.
It's had a wonderful week, a really really
Look at
wonderful
that.
week.
It's
Yeah,
breaking out our previous high. The previous high is pretty much here, and in fact, it's spiked up to previously 22. It's now 23. That's good.
this is
Breaking new highs.
this is now my best performer in my
Yeah,
portfolio.
that's good.
And I spoke to Mo Khan earlier this week, and
Yeah.
they just landed a very large contract, and
Mm.
they are gonna beat their guidance. So
That's
so
good.
all
Yeah.
going very well at HVivo.
Yeah, yeah. Well, do you know what? Gregory says, I got DGI on my watch list, gone up fourfold. I don't know if you were aware about DG Innovate. What happened recently, John, is that they've announced three ex-Tesla guys. I mean, this is a little Welsh company. It was like a 5 million market cap. Three ex-Tesla guys, quite, of seniority there, and now on the board of DG Innovate. They do this battery. So they put, I think, 2.5 million convertible loan note in there.
Mm.
In my mind, that's not enough. This is quite a capital intensive, but they may have deep pockets. Gregory, I would say literally, it may go up, but in my mind, after a rise like that, you've missed the boat pretty much for this rise. That'll be probably the most significant stratospheric rise this company has seen. Because of course it's just the law of numbers, isn't it? The bigger the market cap gets, the harder it becomes to double because you have to generate millions. So if you take it where it was, DGI what's the market cap now? So it's 17 million. When it was like 3 million, it only needed 3 million of perceived value to double. Now you're talking about 17 million of perceived
Mm.
value to double, which is 5 times more than the original double valuation uplift. So as companies get bigger, that's why I like small caps, and because they can double very quickly if they're undervalued. The potential is massive, but of course, the bigger they get, the harder they get to double. So be careful
It's
jumping in that, especially on a
it's a
rise like that.
yeah, it's a nice little space. This the sort of EV drivetrains, EV technology, and there's quite a few companies listed in London that are in this market. I like Equipmake. I still like Equipmake, which does
Yeah,
the bus repowers. Taking old bus fleets, coach fleets,
yeah,
and or very sort of large commercial vehicles and turning them, keeping the chassis, turning them into electric vehicles.
yeah.
Nice little
Well, I
company,
would say,
nice little space. So
yeah, I
you've
would,
got as well.
yeah, I would say that there's a lot of hype in this now because, of course, ex-Tesla guys are there,
Mm.
and you'll also get people saying they're going to hook up with Tesla and all that sort of stuff. That's what's going to be said, and that could even power it even further. But I mean, just basing it on what's just happened and the valuation now, and obviously loss-making stuff. If they, if they don't hook up with Tesla, then they still have to run that business, and they've pretty got good contacts. But there's a lot of hype in this company now. But the
Mm-mm.
time to get into this was,
As I say, I think my preferred play in the sector is Equipmake
yeah,
because they are, they've crossed that commercial threshold. They've gone from being a research-led company to one that's actually selling solutions.
yeah. Rio Tinto, correct, says, are bringing forward the opening of a big iron ore mine
Mm.
in anticipation of bigger demand, greater demand. Where's that demand coming from there? They're assuming China's going to pick up because China's figures have been dreadful, haven't they? And
Well, they've got to pick up at
that's
some
a high
point.
demand.
They've got to pick
Yeah.
up at some point, haven't they? And you do have the you know, the whole. I mean, there's a lot of infrastructure that needs to be built. There's a lot of electrification that needs to happen. So yeah, the demand has to pick up at some point. Remember what we spoke about before, though. You know, miners have been a great source of income. As you know, they sort of prioritised shareholder returns after the last cycle.
Yeah.
That may you know, capital allocation, how they spend their money, how they invest it is now you know what investors should keep an eye on, because it has a tendency in this industry to be misspent, misallocated.
Let's have a look at by all means, you know, get your stock picks in for 2024, please. We'll cover them in a bit, but let's go to the worst performers then. This is the FTSE All Share 73 and AIM. You got Metro Bank there. It's a broken model. Let's be honest. I understand. I remember people talking about this a long time back. I thought, no. I mean, all the banks have been legacy banks that have been doing. Even they move slowly, but even they are shutting down their branches. And if you are literally catering to old biddies who don't do the internet, your literally market is your market is dying. It's dying in front of you. It's and the cost of those those banks in high streets or in middle of cities, not cheap. You know, it's not cheap at all. And to staff those and giving away dog treats and umbrellas is not going to swing it.
Yeah.
You know?
Well, I mean, you know, the reality is you look at any sort of town centre, you know, medium, small sized town, there aren't any banks anymore. Yeah. They've all gone, and there's a reason for that. And so you're right. The model is, you know, proven by the actions of larger banks to be one that is unattractive.
I'm looking at that list there of because is there companies there been sold off because the sector they're in? Is it hard there? I don't know much about the digital line. I know sort of Pod Point, which is has been hammered. CMC Markets came up on a screener of mine recently, and I looked at those, and I thought, what's going on there then? I haven't really. This is CMCX, I think, yeah. But look at that, they've come down massively. But I'm thinking, what's their issue then? I wouldn't mind doing some research on those because they are under there in trading. I just think because they're a broker, aren't they? Trader, broker, CFD provider, and all that stuff. Obviously not the dominant player, but you've got to think if the market picks up next year, then surely more trading will be going on their platform, and that will help them. So it's almost like they have been hammered because of the market. You know, I don't know. I don't know what their specific situation is, but it doesn't seem to me. Well, I don't know. Is it company specific or is it sector specific? And if you look at them, if they're in the same space as sort of like, for example, Hargreaves Lansdown, all that, they based on trading as well, and AJ Bell, they've taken the hammering as well. So I'm thinking if the upturn happens in volumes of trades going through, couldn't they benefit from that? You know?
Yeah, I mean, IG's chart looks a lot nicer than that. So you've got to think there's something company specific going on here.
Yeah. So IG is the dominant market leader.
Although,
that's come down a little bit.
It has come off as well. So weak markets, but it's sort of recovering a bit more quickly. It's a bigger company. It's got the clout. It's got the clout to attract customers back.
What is CMC? What's their market cap? Yeah, 286, I suppose. Okay. We just look at the interim results. What are they saying here? Because they've dropped net income, operating income down 20%, trading net revenue over. Okay, unchanged, 240 million. Okay, operating cost guidance. All right. Yeah, I think maybe they want to look at. I think I don't know. I mean, just thinking, where's the opportunities here? I mean, because some of them, let's be honest. If you look at, I don't know about Synthomer, but Metro, for example, that's you wouldn't if they weren't listed, right? And someone said to you, and that's always I think the rule of thumb. If they weren't listed, and you're not talking about trading the share price, and a friend of yours said, "You invest in my business," and you say, "What is it? I'm setting up these banks in high streets that cater for old biddies who can't do the internet." I'd say I'd be losing a lot of money, to be honest. He says, but we capital ratio is fine because we have to be. But I'd say no, you're all right. You're okay, thanks. I wouldn't go for that. But what are the businesses there? AIM worst performers.
Videndum's interesting. That's
Vid.
hardware, video hardware, content creation. Now, this sector's had a horrible year, as I'm only too aware of because of my little holding in facilities by ADF.
Yeah.
So the writers' strike has obviously not been good for anyone involved in the business of providing equipment or for services for the film and TV industry.
A growing content creation market. Yeah.
Yeah.
Okay. All right. And what was the market cap? 327. Yeah, because they've been hammered a lot. Interim results. Look at the interim results. There was down 25% revenue top line, adjusted profit down 50%.
The other thing, if you look
they
there,
got net. That's straight away. I worry about that. Net debt 216.
Exactly what I was about to point to.
Yeah.
So the other feature of companies on this list. So look at Synthomer at the top, which is specialty chemicals. Pretty chunky debt pile.
Yeah.
So this is, and we spoke about this last time. One thing you need to look at is how much debt a company has. Yeah. And actually, what you've got in the case of Synthomer is that the top line has been contracting, profitability's become harder to come by, and it's got a big debt pile to service. So you sort of triple whammy that you don't want to see. So
what's the result of the rump placing?
Well, it's just trying to raise some money.
Rump.
We're getting rid of the bit that it couldn't place before. So yeah, there you go. There you go. Look, there you go. 798.
Oh, look at that. Yeah, net debt 79. That is worrying. Because 7 and literally double the size of their market cap.
Yeah, maybe there's a screen for the new year actually, because I suspect not all of this would have come out of the wash, but companies that do have large debt piles and sailing close to the wind in terms of their ability to service that debt.
Yeah. AIM, we got anti-power almost going bust. I think they did tinyBuild, literally, gaming
fundraising issue again.
Yeah, and to be honest, I mean, there are two things going on with the problem with them. They got the fundraise, but the founder said he would stump up 10 million. He'd back that. But they've also got a legal challenge from a game they bought, and the previous owners of that game, so they haven't been paid in that. So they go to court, so there's legal problems there. So in my mind, whenever a company has a legal issue, step aside. Business and investing is risky enough as it is. You don't want a court case going against you, especially when you're struggling for money anyway. So that's there. But now, if they clear the legal thing, and raise money, it'll probably fly because they are revenues. They're revenue like 50 million or something. But
look, you can see this. Pretty much every company on that list, and you can see this from that last column, which is forecast PE, do not make any money.
Yeah.
At least tinyBuild has some profits that you can value the business against.
97.8%, and that's one that'll, if they clear one of those issues like the fundraise, it'll bounce, technical bounce nicely. But getting in before that is just very high risk. And at Horizonte again, nightmare. They've been building that sort of mine for 8 years. They come to within a month of operating, they say, "Oh, we haven't got the cash actually." It's going to be end of the next year. What? And the share price, look at this stinker, literally awful. The thing is, if you go for high risk reward, that's the thing. You go. I think always we tend to focus on reward. You should focus on risk because if the risk plays out, there's no reward. And this is a case here in point where literally, and
it's
you get more difficult to raise money. Then it becomes more difficult as the share price and the valuation goes down. So
you get more diluted to raise the money that the company needs to operate. You as a shareholder get more diluted. But it goes back to one of the overarching principles of investment. The first rule. I mean, obviously you want to grow your money, but the first rule is don't lose it. Once you lose money, it's very, very hard to make it back. I think you've run the numbers on this before, but you lose 50%, you've got to double your money to make it back.
Yeah, exactly. Yeah. And I genuinely think sometimes when in small caps, not so bad. I mean, because it can bounce. But I think when you start getting beyond 20% down the company, it starts getting a little bit difficult. So your only line of protection then is that you haven't gone big on it. And that part of my strategy now, this is during the bear market, I've adjusted this. I will not go above 3% pretty much on any company until at least if it starts rising, it's fine. But if it starts bumping up, I never average down because there's something gone wrong. I've done other things, I looked at it, it's still going down. I think, And literally, once you get to 20%, it starts going to be difficult getting it back unless you think there's going to be a positive update. So I'll wait for the next update. And if it jumps on that, fine, then I'm okay. But literally, if not, I'll cut if it's going to be a bad one. But yeah, don't go big on a company because we are at our most emotional. It's like every child you have, the new one is the favorite one pretty much for a while, and you coo over it, and it almost blurs your vision, and you become very biased and subjective about it. So you can tend to go over big on it. And think, this is a brilliant company of research, and finally jump in too much, and it starts going wrong, and you start averaging down because you still think it's a good company. Don't. It's like look at what how the market's treating it. Sometimes it may be off, sometimes the market's right. And you're thinking, So sometimes companies should start, they shouldn't bomb after you buy them, or they shouldn't start going down if you've done all your research. And sometimes you get winners, so you can just keep along, and you know it. Sometimes a winner will start winning straight away. You think, oh wow, and So I would leverage towards winners, not towards losers, and that will help your portfolio.
Yeah.
Okay. Let's have a look at the okay. Some risk reward. A plus for Plexus is that oilers is Riversalt. Oilers need to use their stuff instead of cheap Chinese gear that's likely to leak methane. Yeah. No, I know. I've run I literally, when I fill up a spreadsheet, I do run the broker forecast as well. And it's not, according to the brokers, unless they win new contracts, there's not huge upside.
Yeah,
the time of the game was when Paul did get in, and that's 2, 3, 4, 5 bagger. That's the best game.
Yeah, Plexus. But I do remember, Plexus. When you go back, I'm going back to 2013 here. This company was priced at over £3 a share. We're now in a pence. This company's technology is fantastic. It's these wellheads, and there was a great hope for this company because it followed the Deepwater Horizon catastrophe that this would become the industry standard in terms of wellhead safety, and it didn't happen. So yeah, I understand. There's always a good reason. The technology, there's nothing wrong with the technology. It's selling it is different altogether. There's a long way back up to those heights. A long way back up.
Yeah. Graham says Burford. They are due outcome from a case in YPF takeover. Any appeals by Argentina will be completed by the end of 2024. They have a multi-billion price fixing case versus US meat industry due next year. Oh, Burford. Again, that area though, it can go, anything with legal issues can be binary, can't it? Well, yes or no.
But they do manage. This is what they're set up to manage. It's like an investment firm basically. And I mean the problems with Burford were because obviously they had the short selling attack on it, and I think you can see exactly where that was. And it's image rehabilitation. I mean, the Argentina case. I mean, there has been a change of government there, and just when it comes to investment, the word Argentina is one of the most terrifying words out there, I think.
Yeah, well, that's how big they are, though. They've got a case against Argentina. It's like, and that guy who's now in charge of Argentina, is that the guy, the crazy guy? Who's like, he's devalued the peso, isn't he? And then he wants to go to the dollar. He wants to peg the dollar.
He's quite a character. He's quite a character.
But to peg the dollar, of course, you're going to get a lot of pain first because they haven't got any dollars themselves. So it's going to be hard. I can't see him wanting to give any more cash away. He's going to be struggling as it is.
I mean, I know in the past, there's been some very, large companies that have run into trouble operating in Argentina. Essentially sort of state theft of private property. It's a strange place.
Mark, stock pick for 2024. Yeah, Cizzle Biotechnology, CIZ1 biomarker for stage 1 lung cancer. Yeah, it's got, I mean, put it this way. I don't know if it's going to be successful. I know they're waiting. Have they got paid out yet? Because I know they had an option. They sold an asset apparently to a company. Then this company's got listed in the US, and they had shares in that company. They could sell those shares to get cash back. So they sold an asset. Put it this way: it's got the market cap, and it's in the right area to become a high potential stock. So sub 10 million, these can double quite easily if you get the right kind of news, because you are in lung cancer, one of the biggest, problems in the world, one of the biggest killers. In fact, it is the biggest killer within cancer, and cancer is one of the biggest problems we have in the world. But it's just how much cash they got. They need to come up with some blockbuster numbers.
Well,
But it generally could sort of, it could do that kind of rise. Literally,
that was my first question. How much cash has it got? I'm just looking back at the interims from the 28th of September. Cash at the 30th of June was 451,000.
Yeah. What do they say? They raised that in June 12th. Yeah.
Now they don't spend what they don't do is burn
the option
through
to sell the interest in the royalty sharing agreement. Apparently, they are set. The conduit scheme. So, and that's about 3 million. I think 3 to 5 million. I think.
Yeah.
So
what they don't do as a business, which is somewhat encouraging for a biotech, is burn through enormous amounts of cash.
Yeah. That could be one. Yes. I mean, to get some positive news, anything sub 10, like that in that area can just rally on a bit of hope pipe potential.
Yeah,
And it doesn't have to.
Again, I still, I mean, yeah, there is scope for a small company to obviously get much bigger, but look at Rolls Royce. You can get absolutely fantastic performances out of very large companies.
I'm not excluding that at all. I'm just saying, when I run the figures, pretty much I do it every year, and I look at the best performers, and generally 60% of the best performers are below 100 million market cap. So there are the other 40%, is above that. But then you've got a lot more companies up there to look at as well, and they get a lot more complex and bigger. And in fact, I think 40% of the best performers are literally below 50 million. But you will get these pop and drop stocks, and there's a difference in sustainable rise
pop and drop stocks. So I like that.
Yeah, so a pop and drop stock, a story stock, hope high potential stock that has it's probably pre-revenue, it's very loss making, but it's got a lot of hype around it because of its technology, this market it's in, anything. But you got to be careful on those because they will pop and drop, and they're not commercialized yet. But they can have some very aggressive rallies. And like I said, hope high potential stocks I call them. But
but I mean,
and Cizzle is one of those. It can pop and it can drop. And the reason why it drops to 10 is because they probably need to raise money, and the best time to raise that is after the pop.
Yeah.
So
no, I know what you're saying. I kind of like. I'm looking at now Frasers. So I mean, this is a fantastic chart if you go back a decade.
Yeah.
And it goes back to what we're talking about in terms of the big rises this year. Unloved.
Yeah.
Have had their chance. Their time in the sun this year. It's almost a reversion to value rather than growth as a sort of overarching investment strategy. And it's been a long time coming. It's been a long time coming, but where you see sentiment so far against the company, and here you go, you see that really sort of even before the pandemic, it wasn't a lot of love for Frasers, but that just left so much value on the table. And you've 4.5 bagged from there.
Yeah. No, I know. No, it doesn't have to be all small, but I'm saying sometimes it's just option paralysis, having too many stocks to look at. And I think if you can focus on, because I like to look at companies that are going to be businesses, decent businesses, not pop and drop stocks, hope high potentials. I'll have one or two of those maybe in the portfolio, but generally I want to have companies that are generating revenue, going to be profitable, and can scale. And they are good businesses. They're not share prices just a trade, pop and drops. It's just having time of day, the logistics of covering the entire market compared to just say sub 100 million. It's a lot easier to do that, and I do prefer smaller caps. I just find them more exciting than but no, there are, of course, there are opportunities in bigger cap stocks. Absolutely, we've seen some of the rises. Top performers like Rolls Royce 220%, Carnival under the, but look at these though. Look at the difference. 1100%. I'm not after a 10 bagger. I do want a 10 bagger over 10 years. But I want 100% within a year. No, within 3 years, at least on a small cap stock. I've had three 100%ers this year. The market is changing. I can see it. And the ones that have been hammered, I think, the small caps and micro caps with potential, I think will do phenomenal returns in 2024. And I'm not talking about just 50%. I'm talking about several 100%. And that's what I'm looking for. Is very good businesses, excellent potential that have been hammered. And I believe I have some of those in my portfolio actually. But you've got to be very careful about those kind of companies because the smaller you go in the market cap, the more risky they are. because the more reward they are. But
Yeah.
you've got to make sure. But on the basic level, if it's loss making, how much cash you got? That's the first thing you need to look at straight away. And like I said, with Cizzle, it doesn't have that cash. It keeps promising to get that cash, but because at the moment they can't. The story is the cash until they have cash. Then when they have cash, the story is the hope high potential, and that's when it could take off.
I mean,
but like you said, you get kind of
if more optimism returns to the market this year, then it actually might be easier for companies to raise cash.
Yeah.
And therefore, actually, those sort of binary coin tosses on underfunded companies might actually work out quite well. But it's not a widows and orphans strategy.
Yeah, I think sentiment will help, but of course, the cost of capital is not going to come down that fast because
it's going to come down.
Yeah. I mean, Joe, I was showing this to Paul earlier. We did a thing about bonds. I mean, look at this. This is the UK 5-year bond, right? And if we scroll in, we've gone from 5% pretty much now down to 3.7, and it is dipping below these, past 200-day moving average, and you can see all bonds down today. But now it's in that previous resistance, and it's breaking down below that, so we can see the tide is turning.
Well, it does seem that the traders are betting that the interest rate cuts will come sooner rather than later. And I think I even saw someone allude to the first at a Fed meeting in March, and then you've got the Bank of England the day after.
But Bailey, BS Bailey, he's going to be reducing it the quickest, I think. He's talking a good game. Yes, no, we're not going to keep them high for longer.
Yeah,
no, you won't, fella. When after Christmas, when people start reining in their spending and people start laying off jobs and the economy really starts grinding lower, you will have to, because that will kill inflation anyway. Lack of demand, lack of supply, and in fact, we saw the manufacturing figures recently really not good. Producer figures really dropping off a cliff. And you think, why are manufacturers producing less? Either got big inventory, I can't see that happening, or lack of demand, and that's going to get worse.
But then go back to the big fallers, Synthomer. This is a lack of demand. The industrials have had a really tough year. So I think I can't believe that we won't see some interest rate cuts, central bank interest rate cuts in the first half. Sorry.
Yeah, you said that actually. You said first quarter, I thought first quarter, but now they seem like it's maybe first quarter. I think the downturn will be faster than people think. That's why I also think the markets will have a rally now, for the rest year, maybe into January, but then it'll roll over a little bit when we see the worrying figures of the economy. But then the central banks will step in, and then we're off the races. And
Jamie Constable up at Singer, who we often speak to, he's put out his year-end review. There's a great quote in it, just on the subject of central banks. He says, central bankers will always tell you it's too early to cut until the day they cut.
Yeah, exactly. And that then is the perfect time. Actually, it's right now. Too early cut. Spot on. So what changes between the last time you said we're not going to cut for a long time and you're cutting now? My pick for 2024 is Rockwood Strategic, a small closed-end fund that turns around businesses very well managed. A few tanks need replacing. A few tanks need replacing as well. Yeah, I think from what do you know what? I don't know when this Ukraine invasion of Ukraine is going to stop, but that will help massively if that stops this year. It's been 2 years now in February, isn't it? Or is it? Yeah. Since Russia, February,
pretty much.
Marketing, general election Tories will spend a fortune advertising and still lose. Marketing maybe.
Sorry, just reminded me of something that the election's coming up. And again, it's something that Jamie from Singer sort of jokingly points to in his review, that we've got 40 general elections around the world this year.
Wow.
And which company makes its money out of political polling? YouGov.
They've recovered massively. I I wish I'd bought a great company. I wish I'd bought those at the bottom. And in fact, they haven't. Let's have a look. Well, they haven't really. They've had a little bit of a sell-off, but it's not been. No, it's a great company, and in fact, look at that. You can see there it is trying. It's off the lows, above 200 a day. It's trying to break that. So that it could be a good recovery play. I'm going to look at those again for a big company, because they seem to have. Someone was talking about those. A fund manager, I think Paul had on. And they're saying that 40,000 data points around the world, and they're the most accurate, really. So
Oh,
That is,
it's this. I mean, this sort of stuff is. I mean, it's not just political polling that it does. It's obviously deeply embedded in the whole sort of marketing cycle.
Yeah.
And the marketing cycle has been awful, which partly explains its share price. These were very highly rated shares as well, and they're still not exactly cheap, but it's a fantastic company.
Okay, season's greetings, Super Mono, same to you. Large cap tip for 2024 has to be GSK. It's developed a habit of regulatory approvals for various new drugs. 2024 could be the year it starts fulfilling all the potential. Yeah, GSK, do you know what? Did it rally recently or not? Let's look at this. No, it hasn't. No, it hasn't rallied. But AstraZeneca, which is a star performer, that's down a lot as well, isn't it? It's actually that struggle is
But they had such a good run, didn't they? Pandemic related.
Well, it's not that far down. It's literally from 120 to 102, so 10%.
GSK definitely falls into that sort of unloved value pot type thing I was talking about before.
Yeah, maybe we should do that for the new year, right? Because there are dogs in the footsie. We should do that, because they do say that sooner or later, if we get the worst performing FTSE 100 shares, some of them do very well. For 2020, so the worst performing shares of 2023, we'll look at those at the start of 2024 and see, which could do well. And because like I say, it's not all about small caps, but I mean,
you'd probably think it's quite boring, but GSK hasn't really gone anywhere this year. Just sort of trod water those shares. You get a decent
horrible chart.
Get a decent dividend out of it though.
Yeah,
it's never been it's an unloved company.
I mean, essentially, look at that chart from 2015. It's all it is a massive range. It goes up and down. Up. I'm not joking. You can literally buy, just set an alert at 1320, and it dips down there and rallies, and literally it does that for year on year, and you'll have it, literally it'll go from there up to there, and it'll take 2020 to 2 years. That's 2 years of a run. I mean, literally, it doesn't never seem to have a smooth upward, and it's quite volatile for a big company. It goes up and down, and it's not nice. And I pronounced that a long time ago. I do not like the chart. It's just not very nice looking chart. It's very spiky for a big cap stock. But there we go. Anything else on the tips there? We'll look at now. We're going to look at the screen now. We'll look at growth and value for 2024. Small cap tip for 2024. I shouldn't talk my own, but I just mentioned this.
So it's yours now.
I shouldn't. No. This is Super Mono.
Okay.
But 20 silver bullet data. Apparently, someone took up the entire placing recently. British companies with any link to AI could do rather well next year to affinity and beyond. I did say this because I have a YouTube channel and a website that uses Google Ads. I did get emails from Google talking about the deprecation of third-party cookies, and that is huge. They're finally doing it. And like I said, Firefox done it, Chrome have done it, but it doesn't matter. The elephant in the room here is sorry, not Chrome, Safari and Firefox. Chrome is the biggest internet server on the planet. 65% of people use it. Also, Google Ads is the biggest ad platform. They are finally deprecating, getting rid of third-party cookies, and they have to do another way. And how do you target, potential customers? And it's using contextual, and that's and the 4D AI platform is now getting basically being endorsed by 3 of the biggest advertising agencies in the world. So I think, and it's a huge market, 700 billion a year spent on digital advertising, and it's getting bigger. And it's growing. So I think that I do like that company a lot.
Yeah,
we mentioned that before. But so let's look at this growth and value. In fact, John, I think I've got one in here which I haven't talked about.
Have you? I've got one in here,
and I'm not going to talk about it either because I'm going to wait till next year. But let's look at it. We are.
I know which one you've got.
Yeah, don't say anything. So. Yes. So what is these? These are market cap. What? Take me through the.
So we try to keep it relatively small cap. So 1.5 billion below, which is really that's small cap. We want basically this. So the value element comes from them trading at less than book value, so less than the value of their assets. We want growth, so we want to see EPS growth. And basically that's it. Oh, and I've actually sort of tried to get some sort of balance sheet strength here as well.
Yeah. Okay.
So a lot of these have got net cash. So yeah, that's basically it. It's really, really quite simple. And there's some. I mean, which one I like.
Yeah, XM Media, Time Finance, Mercia, Arix Bioscience, Griffin Mining, Synectics, Wentworth, Anglian Direct. Do you know what? I said that Eco Jubilee, Virgin. In fact, I have two on that list.
Well,
I didn't realize.
sorry, just Wentworth. I should note is being taken out.
Ah, that's right. Yes, yes, yes. Yeah,
But actually, I kind of like that in sense that it almost validates the results of the screen.
yeah, yeah. Listen, yes, it does. Yes, exactly. Because it's undervalued, and there's a company that sees potential
Exactly.
in it. And so, but there's two stocks that I can't talk about. Because what I do in my investment club, if it's a small cap, micro cap stock, I understand it's very illiquid. So if I do a pick, I give them a month to research it. And so I have two companies that are in there I can't talk about
Oh,
until
for goodness
the
sake.
year. Take your
Useless. We have to
pick.
talk about one of the others then.
Well, you can talk about it, but I don't want to say if I own it or not.
Okay.
But yeah, I don't know about Mercia Asset Management. You can do
No.
a
Well, I think, I mean, I don't know much about Mercer asset management, but what I have said before is the whole asset management space
yeah. Let's have a look at Merck on the
is in the
chart then.
doldrums.
Yeah, yeah. Merck. Asset Mercia Asset Management. Yeah. In fact, it's oh no, if I scroll out, it's then from 2016, it's not done very well. But look at that. What the heck? It's a 22% rally there recently
Yeah,
on the
yeah.
23rd of
Well,
November.
I mean, funny enough, interestingly, there's sort of. I'm just having a look at the share pad summary. It's focused on the SME market,
Oh, okay.
small companies, and helping to provide capital for smaller companies. And there's another company on that list which does exactly the same. Well, not exactly the same, not in exactly the same way, but is focused on that market, Time Finance, which we talked about before, and which I think, yeah, I've liked the look of that for a while. I just haven't bought it, annoyingly. Angling Direct.
Yay. There we are. It's it's trying to get up there. Look at that line there. It's gone above that. It's finished above that. That's John. I think it's going to go well. You could even see the 200-day moving average turning up now, which is
Yeah.
very good, and the share price above that,
Well,
which so that's quite good technically.
the numbers in this, the numbers in the screen here are quite misleading because says it's on a trading on a forecast P of 35. Well, that's not exactly true because it's got 17 million quid worth of net cash.
Oh yeah, yeah. So
It's just
you need EV valuation then EV EBITDA.
yeah. I should. Oh no, I didn't
Profit. Yeah.
add the column, but yeah. So it's sitting on hence why trades at less than book value. But Angling Direct, who is it that bought? Someone bought a stake recently.
I don't know. So this screen is worth looking at, ladies and gentlemen, because, like I say, they have growth and they've got value. Those, in my mind, are the most two important metrics. And also, like I say, you've got some balance sheet health there. But sometimes a company doesn't have to be squeaky clean, healthy for the share price to rally. If they've got growth and value, that's good. I mean, if they've got really bad balance sheet, it can hold them back. But it doesn't have to have the healthiest balance sheet of all companies as long as it's okay. But as long as they've got growth and value, that's very important. And so that's worth looking at. Jubilee Metals, Virgin Wines recently. So you can have there we are.
Downgrade to a Downgate Wealth is like it's building up a reasonably chunky position in Angling Direct. I can't remember the company that bought in the other day. So Naked Wines, Naked Wines. Yeah, they had some news out today.
I didn't realize that. That validates my spreadsheet analysis. They've got two companies in that list. I didn't realize, and I obviously didn't know what list you were bringing up today. But I do quite like that. Yeah. So who's holding? Was it?
Well, you've got Dowgate Wealth,
Kelso.
Yeah,
Okay.
they're a value investor, basically.
There we are. See, a good company there, John.
There you go. We've got there before them. Yeah, Naked Wine has some numbers today. They're not pretty. Headline figures down, revenues down 20% reported currency. Loss making, but you've got to think that both Naked Wine, Virgin Wines. I mean, how much worse can it get? How much worse can it get?
Yeah, I know. I did look at that on a screen a while back. I thought, wow, exactly. That's the kind of company. So let's look at Naked Wine a sec, because when you think, it's almost like the very unloved. Sometimes we talk about this. If they're not a basket case, they can rally very strongly. So what are they? They're 21 million market cap. Results here of 59 million. They're making a loss. EBITDA 1.8, so they are making what, 700 grand loss. That's all. They got cash of 5.5, no debt. So I
Yeah.
like that, no debt. At that cash burn rate, and we are talking about, will it get worse? It may get worse, but I mean, is that priced in? It's one of those things where it could start rallying. When it starts rallying, more people pile in, the momentum takes over, and you almost forget the value and the growth and the fact that the market isn't that strong at the moment.
Yeah, well, Naked Wines is probably twice the size. No, it's 4 times the size. But again, it's got net cash. It's got no bank debt and it's got liquidity. So disastrous. So that share price looks. This company's not going to disappear unless somebody decides to buy it.
So what's that? Naked, naked
wine.
So what am I looking at? Which one?
So Virgin Wine's popped out the screen.
Oh, that's VINO. Sorry, that's VINO. Sorry,
VINO.
Yeah. I was looking at.
But I would imagine that share price graph is not going to look a lot different to that.
Yeah. But it's funny how obviously the one went for wine and the other one said, and Virgin said, "Can we have our ticker as wine?" And that's been taken by Naked. And then what else can we go for? VINO. He was French.
It's a nice ticker. Yeah, glass of VINO. But yeah, so anyway, both of those companies, as I say, Virgin's popped out the screen. Virgin Wines and Naked Wines is not in a dissimilar position.
So Naked Wines 34. Let's look at half year. Let's look at this. 34, 132. Wow, revenues are down 20%. Adjusted EBITDA loss before tax 9%. Net cash at least net cash excluding 2.8. So Virgin's better, isn't it? Better place there, really. Smaller. It's got more cash compared to its market cap, and the loss is less as well.
Yeah,
so,
but I mean, again, as I say, it's popped out the screen. Both of these businesses have been troubled, but worthy of a bit of investigation, perhaps, because they're not going to disappear off the face of the earth, and there's a lot of recovery to be had there.
Yes.
But what's the catalyst for that recovery? Going back to our earlier conversation.
Gregory's OBD. Is it OBD you said? Yes, we've covered that before. We did have that blockbuster Oxford Biodynamics. Of course, they came up with that amazing game-changing tech that improves prostate cancer tests from like 60% up to 95%. It's ridiculous, which is phenomenal. Where's the chart on that in a moment? Let's look at this. OBD. Again, I do send a look at it. I mean, it's all right. I do. If I'm not reading my detective book at night when I'm in bed, I just all I do is research companies pretty much. And I was literally looking at this company around that level. I thought they're burning too much cash. They need cash.
Up and drop,
I didn't know they would come out with that kind of news. If I did, I would have probably jumped in them. But that's a gut thing when you do that. You research a company, and they come up with the news of that. But excellent technology those. Anything else there you're talking about? Frasers. Sorry, Mike Murray, CEO of Frasers, gets 100 million shares when the SP hits 15 quid. Staff get a big payout when shares at £10. No, sorry, 10 million shares. He gets 150 million. He gets 150 million. The CEO. I'd be buying the shares myself if that was the case.
An incentive.
A massive loan. I mean, take a 50 million quid loan out and just start buying shares. Everyone buy.
No. Actually, there's that you mentioned the viewer mentions there that the staff are incentivized as well, and I think that's an important thing to note about Frasers. It had this reputation for treating its staff badly, but in fact, financially, it treats its permanent staff extremely well indeed.
Yeah. So it's almost like we'll shout at you, but you get paid for it. So what is it? Since you go GFK panel business takeover will significantly add value. What does that mean? GFK. What does that?
It's another polling group. They made a big acquisition this year.
Oh, okay. Riversoft here says conviviality went bust in 2018. Is wine generally a bad neighborhood for investors? Yes, maybe. I mean, it's not my kind of cup of tea. I'm just saying they could rally. That's all.
Conviviality was an accounting disaster.
Oh, is it? Okay.
Yeah, awful.
Okay. Well, that's it, ladies and gentlemen. That's it for the year. That's let's just cover off one bit of it. It's a little positive news actually on the old PMIs, which is quite good. UK services. We've obviously got manufacturing and services. Services in this country about I think it's about 70-80% of the makes up our economy, service sector. So you want services to be strong. Manufacturing is still, went below forecast, but look at that, it's above 50, which means growing, and services 52.7, above 51 the estimate. So the composite for both of them is above 51. So that's not bad.
The only worry about the services PMI being strong is that suggests pricing in the sector. Well, not necessarily, because I would imagine it's seasonally adjusted, but it means that pricing in the sector, is going to be still quite high. So the possibly the stickiest component of inflation is service led.
Yeah.
In the UK,
there's the highest in 6 months, and up from November's final reading of 50.7. So, but the thing is, I suppose the good thing is it's not tanking. Services
no, indeed,
is not a bad thing.
Indeed.
So there we are. So what? Go on.
I said I didn't get to wear my Christmas hat, but I did wear my Christmas T-shirt.
Duke and Duke.
It's the greatest Christmas film of all time.
It is amazing.
There's another debate.
When I as a kid, when I used to literally, I watched that so many times. I loved it, and even though I still didn't understand how the orange juice trade was going at the end.
No, I don't think anyone did.
They're shorting it, and I thought, what the?
They were doing both, weren't they? They were doing both. They were doing both.
Yeah, I thought, what the heck is that? Yeah, there's a good line in it. Was when Dan Aykroyd's in the train. In fact, I can't say the actual line, but all he hears is a monkey, a monkey. No, he said, I'm a gorilla. I'm a gorilla, you effing clown. And the guy's dressed as a clown. So you effing clown.
It's a cracker.
That,
I must watch it this Christmas.
Yes, it's one of the best. Excellent. Well, Merry Christmas, everyone, and keep hitting that subscribe button. We could be back. You never know. Who knows? And Merry Christmas, John. And
Merry Christmas. Merry
next
Christmas
year.
all.
And I hope you benefit from a Santa rally, everyone. Until next year, have a happy Christmas, Merry New Year, everyone. Merry New Year.
Merry New Year.
Said in the old thing. Yeah. Cheers, everyone.